Why private credit should have a real place in 401ks. Insights from Centerbridge. Imagine a world where your retirement savings could grow in a way that feels both safe and innovative. That's the vision Centerbridge Partners is bringing to the table with their push for private credit in 401k plans. But here's where it gets controversial. Many are questioning whether this is a step in the right direction for the average investor. Jeff Aronson, co-founder and managing principal of Centerbridge, believes that private credit has a real place in 401k portfolios. He emphasizes that the key to making this work is transparency. Investors need to fully understand what they're investing in. This approach is not new for Centerbridge, a New York-based firm that has been managing around $42 billion in assets as of March 31st. They launched their private credit strategy way back in 2007, showing a long-standing commitment to this investment avenue. Private credit, for those who might be unfamiliar, involves lending money to companies that don't qualify for traditional bank loans. The returns can be higher than those from bonds or other fixed-income investments, but they also come with higher risks. By introducing private credit to 401k plans, Centerbridge is aiming to provide a broader range of investment options for retirement savers. And this is the part most people miss. While private credit can offer attractive returns, it's not for everyone. It requires a deep understanding of the market and a willingness to take on additional risk. So the question remains, is this a smart move for the average 401k participant? What do you think? Share your opinions in the comments below. Your 401k at risk. Billionaires' next bailout scheme explained. Your 401k could become the next target for billionaires' bailouts. Imagine a scenario where your hard-earned retirement savings are at risk of being exploited by wealthy private equity firms. The Trump administration seems poised to enact an executive order that would enable these firms to access the vast amounts of money stored in Americans' 401k accounts. What could happen if Wall Street suddenly gains the ability to tap into the trillions of dollars that individuals have set aside for their future? In today's episode of Lever Time, host David Sirota engages in a conversation with former federal regulator Ted Seidel and economist Eileen Applebaum. Together, they delve into the potential implications of private equity on the retirement funds of everyday Americans and discuss strategies to safeguard your financial future. For those interested in exclusive content, including ad-free episodes and extended interviews, consider becoming a member at levernews.com/join. Your support helps sustain independent journalism. If you wish to contribute a tip to The Lever, you can do so by clicking here. Your generosity enables us to continue our work in providing unbiased news coverage. Transcript. Below is an unedited transcript of this episode. If you intend to quote any section, please ensure its accuracy by listening to the audio. David Sirota, welcome to Lever Time, brought to you by the Lever's reader-supported newsroom. I'm David Sirota. It's likely that you're aware of the troubling pattern that emerges when private equity billionaires descend upon your community for a buying spree. Typically, this leads to negative consequences. Local factories face layoffs, hospitals increase their prices, and beloved stores close their doors for good. Private equity executives often claim that their aggressive strategies yield substantial profits for their investors. But what happens when these same tactics are applied to your retirement savings? Will you benefit from their actions, or will you find yourself on the losing end? Are you going to be seated at the table with these billionaires, enjoying the feast, or will your 401k be the dish they serve? This is not merely a theoretical concern. The Trump administration is reportedly contemplating measures that could make this a reality. But here's where it gets controversial. How do we protect our financial futures in a landscape where our savings could be at the mercy of corporate interests? What are your thoughts on this issue? Do you believe that private equity firms should have access to retirement accounts? Join the conversation in the comments below. Private equity in 401k plans. 14% returns versus hidden risks you must know. Get ready for a game changer in the world of retirement savings. Private equity, once a playground for the ultra-wealthy, is knocking on the door of your 401k. But is this a golden opportunity or a risky venture? Let's dive in and explore the potential rewards and pitfalls. The private equity revolution, unlocking opportunities for all. In a significant shift, retirement savers with 401k accounts are gaining access to the private investment market, traditionally dominated by the rich and institutional investors. BlackRock, the asset management giant, plans to offer a 401k retirement fund with a twist, including private investments. This move, along with similar announcements from other retirement plan providers, is set to open up a $12 trillion market to everyday investors. But here's where it gets controversial. The Trump administration is reportedly on the brink of signing an executive order to guide the inclusion of private investments in 401k plans. This move has sparked a debate. Is it a step towards financial equality or a risky gamble for retirement savers? Understanding private equity. High risk, high return? Private equity firms raise capital to buy, manage, and sell companies for profit. Unlike public companies, private firms face fewer regulations and reporting requirements, making them a high-risk, high-return proposition. Investors, typically the ultra-wealthy, are drawn to the potential for significant upside. However, the lack of transparency and the speculative nature of investing in private companies come with their own set of challenges. Why the wealthy love private equity, a high-stakes game. Wealthy investors and endowment managers have long favored private equity funds for their potential to outperform the stock market. Over the last 2 decades, private equity has delivered average annual returns of 10.5%, according to Investopedia. But with great rewards come great risks. Private companies often operate with less transparency, and their financial health can be harder to assess. The risks, a double-edged sword. Private equity investments can be riskier than stocks. While stocks carry their own risks, investing in an S&P 500 index fund means putting your money in well-established companies. Private equity, on the other hand, often involves companies in distress with higher rates of bankruptcy. Caleb Silver, editor-in-chief of Investopedia, warns that private equity is more speculative in nature, as investors are betting on companies with no proven track record. Given the inherent risks, Silver advises everyday retirement savers to limit their exposure to private investments to no more than 10% of their portfolio. It's a cautious approach, but one that recognizes the potential pitfalls. Managing risk. Target date funds to the rescue. Some of the emerging 401k offerings, like BlackRock's planned target date fund, aim to mitigate the risks associated with private equity. These funds offer a mix of investments, including publicly traded stocks and bonds, along with a smaller allocation to private investments. The idea is to provide a more balanced approach, allowing investors to benefit from the potential upside of private equity, while reducing the overall risk. Legal considerations. A green light from the Trump administration. In 2020, the Trump administration issued an information letter clarifying that 401k-type retirement plans could invest in private equity without violating federal regulations. This move has opened the door for retirement plan providers to offer private investments, but it has also raised concerns about investor protections and transparency. The debate. Too risky for retirement savers? Critics, including Senator Elizabeth Warren, have voiced concerns about the potential risks of private investments for everyday retirement savers. In a letter to the CEO of Empower, Warren highlighted the sector's weak investor protections, lack of transparency, and expensive management fees. She questioned how retirement plan providers would ensure the safety of billions of dollars in retirement savings. Empower, in its response, argued for the democratization of private investing, stating that retirement savers deserve a chance to access this lucrative market. However, leaders in the 400k industry, like Thomas Gahan of Procyon Partners, believe that explicit legislation or an executive order from Trump would provide more comfort and clarity on the issue. Gahan predicts that more 401k providers will offer private investments as an option within target date funds, but he cautions that allowing retirement savers to invest in funds made up entirely of private investments may require explicit legislative permission. Final thoughts: a cautious step forward. The inclusion of private investments in 401k plans is a complex issue, balancing the potential for high returns with the risks of investing in private companies. While some see it as a step towards financial equality, others caution against the potential pitfalls. As the debate continues, it's essential for retirement savers to stay informed and make cautious, well-informed decisions about their investments. What's your take on this? Do you think private equity has a place in retirement savings, or is it too risky a proposition? Share your thoughts in the comments, and let's spark a discussion.